Welcome to Boutiques Update with me, Joanne Baynham. Today I'm joined by Philip Short, Global Equity Analyst at Flagship Asset Management. Welcome.
Hi.
You've just recently joined Flagship.
Yes.
So what, of all the asset managers out there, why did you choose them?
So Flagship is a specialist global boutique asset manager. As a global asset manager, the investment universe is much larger than looking only at South Africa. So that's a huge plus. It gives us and our clients many more options of where to invest, and it makes my job or my work a lot more interesting. Different companies, geographies, sectors, asset classes. Many South African investment firms started off first focusing on South Africa and then later developed a global offering. Whereas Flagship, first and foremost, has always been a global asset manager with one or two local domestic legacy funds managed by Neil Brown and Paul Floquet. I'm very interested in global macroeconomics, and at Flagship I have the opportunity to get involved with global asset allocation and co-manage the flexible funds.
Okay, so when I think of Flagship, a lot of your presentations are sort of stock picking related, and yet you said your emphasis is global macro. How do the two marry? Are you a macro house or are you a stock picking house? How does that work?
We do both. So as an analyst, it will be bottom-up stock picking, but we do have an asset allocation committee that looks at the asset allocation within equities that would form a larger or a smaller part of the greater part of the portfolio in the flexible funds.
So the macro environment today is probably one of the trickiest I've ever seen, and I've been in markets for over 25 years.
Yes.
And to give you an indication of that, every manager I've interviewed loves US Treasuries, and that hasn't worked. So, and I know you said you're a global equity analyst, but you're also a PM on other multi-asset funds. Talk to me about the macro environment as you're seeing it at the moment and what you're thinking.
I agree with you. It's very tricky at the moment. There's obviously many things to consider, but the two that stand out for me right now is one, inflation. I think it's pretty obvious, it's a big talking point. It is very important because inflation feeds into interest rates, and interest rates determine valuation and liquidity of all asset classes. So obviously you get that call right, half your job's done. The second one is corporate US balance sheets, and I think that hasn't received enough attention. Regarding inflation, the problem that we have now is that you've got the US fiscal policy at odds with US monetary policy. US monetary policy, which is driven by the Federal Reserve, is hiking rates to curb inflation, while at the same time you've got US fiscal policy driven by the US government and the Treasury, which is suspending debt limits, spending a lot of money, widening the fiscal deficit, and that's actually supporting inflation. So those two are at odds with each other, and I think that's complicating the inflation picture in the US at the moment. On the US corporate balance sheet, we've seen in the last year and a half interest rates going from 0 to 5.5%, and that's quite a rapid interest rate curve. Now, corporates in America over the last 20 years have cash as a larger percentage of assets than they have, and that's been going upwards. They've taken that opportunity and they've moved that excess cash into higher yielding money market funds. So they're actually in a stronger position financially speaking for now. What we have seen in data is that in the next 6 to 18 months, you're going to have a lot of corporate debt that is maturing, and that will need to be refinanced. And you guessed it, it's going to be at high interest rates. So the nominal amount of debt that needs to be refinanced is huge and growing. The interest rate that you're applying to that debt is double. So the early evidence that we are seeing as in the first 6 months of 2023, the number of US corporates that have gone bankrupt is larger than any other first 6 months of the last 13 years, bar 2020 and COVID. So we are seeing stress of US corporates.
If that's the case, why are spreads on high yield so incredibly low still? Or is it dominated by companies that are flush with cash? Because to your point about this kind of refinancing risk that you're talking about, if you look at the large companies, they're cash flush, they're positive cash on their balance sheets. So they don't have that refinancing risk. The small cap companies do. But what I can't square the circle on is why high yield debt spreads are so low.
You see that in VIX, so that the volatility index for equities that's being suppressed. You're seeing that in the MOVE index, which is for the bond volatility index equivalent. Investors are complacent.
Okay.
So, and I think it is that the economy is doing quite strong at the moment, surprisingly. And it's because two things. You've got US fiscal policy, as I mentioned, which is still pumping money into the economy. And you've also got personal savings, which have come, excess savings from COVID, and the consumer's been pulling down and drawing down on those savings. Current run rate, unfortunately for US consumers, they're spending about $80 billion a month. They've got enough runway to about May 2024. Then that money's gone. So that's the conundrum that we have at the moment. I think that the US fiscal policy mixing up with US monetary policies making a blurry picture.
And how does OPEC come into this thinking around, you talk about government fiscal policy at odds with monetary policy, but then you have OPEC, and you have still got supply, and you have commodity companies not putting money into capex. So explain to me how that fits into your thinking on inflation and your macro views.
Yeah, so from what we can see since 2014, the energy complex has underinvested in expansion. And so there's at least a good couple of years where that would have a limited effect on limited supply on oil. We see just the slightest cuts in OPEC in these last couple of months, which has pushed oil up from $75 3 months ago to over $90 now. 25% increase in 3 months. So whilst you still have a stronger economy than people expect, the demand is still there, but the supply is tapering off. And that's putting further upward pressure on oil. Okay,
so these are kind of the top-down macro views that you clearly love, and this is part of your job. How does this kind of go into portfolio construction right now? So I started off by talking about US Treasuries, and people are worried about inflation going forward, or whatever they're worried about, and it's driving the yields higher. How do you think about it from a portfolio construction? What are you doing? Because you talk about you're a global equity analyst, so which stocks are you finding particularly attractive? I mean, I know in your funds, 1 or 2 have actually been bought out recently, so well done. You've made some really good calls. So maybe just give us a feel for like asset allocation and then some stock picking ideas that you're looking at.
Sure. So on the flexible funds, we're at the lowest equity allocation that we can be within our own limit of 60% equities. 35% is in cash or near cash interest-bearing instruments, which are yielding 4 to 5% yield in US dollars. So we think that's a great blend of where we need to be in the current macro environment. On the equity side, we recently added British American Tobacco, a nice boring stock, 10% dividend yield, 6.5 forward PE, 5% earnings growth.
I'm going to stop you there. I mean, I've lost count the number of times I've interviewed people and they tell me that BAT is their number 1 stock that they're buying. Why is it so cheap? Is it just an ESG factor? Is there something you guys are missing? Because everybody loves BAT and yet the share price doesn't seem to do an awful lot. So why is it so obvious? Because the market seems to think it isn't.
Great question. I've recently done an equity piece on BAT.
Yes.
And the main problem is there's a lot of regulation. So they have 40% exposure to the US, and with the FDA, there's a lot of scrutiny on tobacco. And to cut it short, about 12 to 15% of BAT's portfolio is next generation products. That's growing at 30% year on year.
Okay.
You've got 15% of the rest of the portfolio, which is combustibles. That's where the regulation is very hard. That's still growing at low single digits, but that will taper off later. So the inflection point is have the traditional business sort of come off. As it's coming off, you've got the next generation products such as vaping growing very strong double digits. So that's how we've done our work around it.
So you think the dividend's safe, in other words?
Yes.
Okay.
Yes.
Because that's a very attractive dividend yield.
It is, and it's in pound sterling. And they're still growing earnings at 5% per annum in pound sterling. Secondly, we've added energy. We added Shell and Total at $75 to $80 when oil was $75 to $80 a barrel. They are very cheap relative to their own history and relative to the market. That was at $75. We're now sitting at $90. They got almost no debt. So we all look from the top down. We also want to look at companies that have no or very little debt in a rising interest rate environment. And then interestingly, they can pay out a dividend and do share buybacks, both of them when oil's at $50 a barrel. Sitting at 90, they can just do so much more share buybacks. So as a whole, we're looking at low beta stocks. We're looking at companies which are cheap with low debt, low beta, and where there's greater earnings visibility.
And how do you marry the sort of ESG factors into your portfolio currently? Because both oil and tobacco are not usually at the top of a list of an ESG fund. Or are you saying, I want to make money for my clients and we think these are good companies?
Yes, ESG is a consideration. I think it's the delta. So where's BAT today? BAT's not going to disappear tomorrow. What's BAT doing about its ESG? It's moving to next generation products. So there the delta is being more positive.
Okay.
If we look at oil and gas, what are the oil and gas companies doing? They're moving more into renewables. So the shift today, it's not ideal, but we need oil and gas today. The reason that we have underinvested since 2014 is because of overbearing ESG concerns. So there hasn't been a good runway to go to next generation in tobacco and in oil and gas. So we look at being shareholders, we can drive change for today, and we think those companies are making a better change for tomorrow.
And that what we haven't spoken about is stuff you're not buying. NVIDIA has been the poster child for 2023.
Yes.
Would you be a buyer of this stock? And if not, why not?
Currently too expensive. Secondly, we see a massive inventory buildup on NVIDIA and other semiconductors. And if you look back on the last 3 recessions, there's always been a massive buildup on semiconductors specifically, which has been preceded a recession. So you've obviously seen it's been very scarce. NVIDIA's got these great gaming GPUs, and you've seen a huge buildup in inventory. That has driven sales through the roof, as we've seen. When the economy starts slowing down, and we're already seeing, I've seen in some Taiwanese newspapers that there have been some halt on orders from TSMC, which produces chips for NVIDIA. The moment that they say, wait a minute, economy is slowing down, we've got enough inventory here to last us for the next couple of years, you're going to see those sales fall off a cliff.
So you're not buying into AI is going to change our lives and it's a structural story and it doesn't matter if economy is slow. You're not buying into that argument?
No, I disagree with that. We definitely do buy into that. It depends on the price you pay and where we are in that cycle. In early 1999, Cisco had the same story with routers. Everybody had to have a router because the internet was going to be everywhere. The thesis was right. It just took you 20 years to make your money back on Cisco.
Philip, thanks very much for sharing your time with us today, and I hope you enjoy being at Flagship. It's a great little company.
Thank you very much.